Happy Friday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. It's been a big week. The focus of today's video must once again be on the massive rollout of sweeping tariffs and what this means for the global economy. Let's jump in. Wall Street was rocked Thursday by the steepest market sell-off in years, triggered by US President Donald Trump's sweeping new tariff plan, the most aggressive trade measure imposed by a US administration in over a century. Stocks lost roughly $3.1 trillion in market value, their largest one-day decline since March 2020, the start of the pandemic. Stock index futures drifted lower Thursday evening too. In Thursday's market plunge, the Dow Industrial dropped 1,679 points, or 4%. The tech-heavy Nasdaq, which powered the market higher for years, was down 6%, pulled lower by big declines in Nvidia, Apple, and Amazon.com. The S&P 500 fell 4.8%. The market turmoil came as the full implications of Trump's America First economic policy began to sink in. Economists warned that the president's steep levies on foreign goods would significantly slow economic growth, push inflation higher, and potentially handcuff the Federal Reserve's ability to respond effectively. Bruce Kasman, chief economist at J.P. Morgan Chase, was blunt. Quote, "If the tariffs go ahead as announced, they'll likely push the US and the world economy into recession this year." End quote. The US president had long warned that he would transform the global trade system to be, as he argues, more fair for the United States. He also warned that there would be significant short-term pain. It appears that the markets had not anticipated just how painful this shift would be. The impact was swift and brutal. Companies heavily reliant on global supply chains, such as Apple, suffered steep losses. Apple lost more than $300 billion in market value on Thursday alone. The Russell 2000 index, which tracks smaller and domestically focused companies, officially entered bear territory, down 20% from its 2021 peak. The tariffs, aimed at reasserting American manufacturing dominance and extracting geopolitical concessions, have, as one would expect, rattled financial markets across the globe. Quote, "This isn't just about trade," end quote, said Irene Tankel of BCA Research, adding, quote, "It's about confidence, capital flows, and the basic mechanics of a global economy that's being upended," end quote. Many economists now expect inflation to spike. Barclays forecasts a 3.7% increase in core inflation, while Nomura sees the figure reaching 4.7%, a level not seen since the early days of the pandemic. Meanwhile, GDP growth forecasts are being slashed. Barclays predicts the economy will contract slightly in 2025, this is the US economy, while Nomura expects just 0.6% growth. Of course, it will be much more painful for the dozens of countries reliant on selling to the United States market, the world's biggest, suggesting that they have large incentives to negotiate a deal with Washington, a deal which would likely be in the favor of the United States. The Bloomberg Dollar Spot Index dropped as much as 2.1%, its largest intraday decline since the index's inception in 2005, calling into question the dollar's reputation as a safe haven. Investors flocked instead to US Treasury bonds and gold, sending bond yields tumbling and reviving recession-era investment patterns. The yield on the 10-year Treasury briefly dipped below the critical 4% threshold, and money markets are now pricing in at least 4 Fed rate cuts this year. Prominent bond investor Bill Gross weighed in with a sobering warning. Quote, "This is an epic economic and market event, similar to the end of the gold standard in 1971. Except with immediate negative consequences. Investors should not try to catch a falling knife." End quote. Even as financial markets reeled, Trump remained confident. Speaking aboard Air Force One, he said he was, quote, "happy," end quote, to see interest rates falling, and claimed that every country had contacted the White House seeking tariff exceptions. Quote, "The tariffs gave us great power to negotiate," end quote, he said. Asked whether he would consider rolling back some of the levies, Trump responded, quote, "It depends. If someone gives us something phenomenal, we'll look at it." End quote. Elsewhere, hedge funds slashed equity exposure at the fastest pace in 12 years, according to data from Goldman Sachs, while a poll from the National Association of Active Investment Managers showed the lowest allocation of U.S. equities since late 2023. HSBC analysts forecast that Trump's trade policies could accelerate a shift away from U.S. equities and into international markets, compounding the underperformance of corporate America. Jim Zelter, president of Apollo Global Management, for example, expressed today, quote, "The risk is no longer just about tariffs. It is about credibility, consistency, and whether policy choices are being made with a clear-eyed understanding of global finance." End quote. He put the odds of a US recession at 50% or higher and warned that higher inflation could limit the Fed's ability to cushion the blow with aggressive rate cuts. Still, some market watchers see a path to eventual recovery. The chief investment officer at UBS Global Wealth Management, for example, noted late yesterday that while volatility will remain elevated, tariff negotiations could soften the blow in time, expressing, quote, "Tariff revenue could offset the cost of extending tax cuts, and we would expect the Fed to respond to weakening growth with rate reductions." End quote. In the meantime, uncertainty rules the day. Stocks and bond yields are falling in tandem, a classic signal of deteriorating economic expectations. With global investors bracing for more pain and policymakers still debating the path forward, Wall Street and the world may be entering a new, more volatile economic era. Obviously, the US administration is facing a lot of criticism for these market conditions. Proponents of the president's move argue that transforming the global trade system is, of course, going to create a lot of short-term pain and uncertainty, but that once this period has passed, the US and those countries which have been able to negotiate a secure place in a wider trade bloc with the US will be on a much healthier and stronger growth path. Whether this ends up being the case, of course, only time will tell. And we will be following this story very closely in the weeks and months ahead. If you'd like to join us as we follow this changing world order, consider subscribing and hit the bell notification icon. And if you're getting some value from today's episode of Market Update, don't forget to hit the like button. Now, as bad as the market turmoil was in the United States, it was much worse in Asia. Japan's Nikkei stock average sank 2.6% Friday morning, following a 2.8% drop the previous day. The US tariffs, 34% on China, 25% on South Korea, and 24% on Japan, have thrown into disarray recently restructured supply chains that were designed to sidestep previous US-China tensions. Economists warn that the measures could sharply increase the risk of a global recession. Yip Jun-rong, a strategist at IG, for example, expressed today, quote, "At the core of the market sell-off is the repricing for higher recession risk." End quote. Japan's bond yields fell alongside US Treasuries, reflecting investor jitters. The new tariffs particularly undermined the China Plus One strategy, which had led manufacturers to shift production into Southeast Asian nations. Vietnam, the biggest beneficiary of this shift, now faces a 46% tariff rate and risks losing up to 6% of its GDP, according to Bernstein analysts. Electronics, smartphones, apparel, and footwear, core Vietnamese exports, are among the hardest hit. Japan, South Korea, Taiwan, and others expressed disappointment and pledged to mitigate damage. Japanese Prime Minister Shigeru Ishiba decried the tariffs as, quote, "extremely disappointing," end quote, noting Japan's long-standing investments in the US. Japan's central bank faces its own dilemma. With exports under threat and stock prices tumbling, the Bank of Japan is under pressure to hold off on further interest rate hikes. Seoul is crafting separate plans for its shipbuilders and automobile sectors, while Taiwan condemned the 32% levy as, quote, "strongly unreasonable," end quote. China, unsurprisingly, responded with the strongest rhetoric, branding the US as a bully. The Ministry of Commerce said it would, quote, "resolutely take countermeasures," end quote. It accused Washington of, quote, "ignoring the benefit it has long reaped from international trade," end quote. Now, we will explore China's reaction and the implications of these tariffs on China in much more detail in today's episode of China Update, my other channel. Southeast Asian nations, who have been hit very hard, adopted a more conciliatory tone. Malaysia, Singapore, Singapore and Thailand all ruled out retaliatory tariffs for now. Singapore's Minister of Trade and Industry, Gan Kim Yong, said the tariffs may force the country to revise its growth outlook downward and warned that retaliatory actions would only increase import costs. Thailand's Prime Minister announced the creation of a task force to explore mitigating strategies and open dialogue with the United States on trade relief. Currency markets also responded. The yen surged to a 6-month high against the dollar, driven by expectations of US economic pain and dovish Federal Reserve policy in response to inflationary pressure. But analysts warn that the rally may be short-lived due to Japan's structural economic challenges and speculative trading patterns. The currencies of Australia and New Zealand plunged on Friday. The Australian dollar, among the world's most traded currencies, weakened 1.4%, while the New Zealand dollar, also in the top 10, fell 1.2%. The two economies are highly exposed to global demand, with Australia a key supplier of commodities to China and other emerging markets, which turn these commodities into final products, which in the past were exported to the US. The broader concern is that the tariffs could plunge the United States into stagflation, stagnant growth paired with rising inflation, making it harder for the Federal Reserve to cut rates. Asian economies heavily reliant on US markets now face uncertain futures as investment shifts and trade agreements hang in the balance. Once again, this shows that the United States, with its huge consumer market, has massive leverage if it wanted to negotiate deals with these countries. These countries, many of them trade surplus countries, do not have any other large markets to turn to. Interestingly, India may benefit in the near term. Hit with a lower 27% tariff, it could emerge as a competitive alternative manufacturing hub, but experts say sustained gains will depend on a comprehensive US-India trade deal. As global supply chains reel and political tensions mount, the world's largest importer may have signaled that the age of open trade is over. And finally for today, in contrast to Asian trade partners, French President Emmanuel Macron is calling for a unified and forceful response from Europe. In a statement from Paris, Macron urged European companies to pause investments in the United States, warning that it sends the wrong message to invest billions into an economy actively imposing punitive measures against the EU. His remarks reflect growing frustration within the bloc and the desire to assert European strength in the face of what he described as economic coercion. Among the retaliatory options under consideration is the activation of the EU's anti-coercion mechanism, a powerful legal tool that allows the bloc to strike back against unfair trade practices. Possible measures include imposing tariffs on US goods and targeting highly profitable American digital services that dominate the European market. Germany has also voiced its alarm, with the Vice-Chancellor drawing a frankly dramatic comparison between Trump's economic tactics and Russia's military aggression in Ukraine. Quote, "The magnitude and determination of the response must be commensurate," end quote. It goes without saying that invading a country and placing taxes on a country's imports are significantly different actions. Macron stressed the need for a collective EU response rather than fragmented negotiations by individual companies seeking exemptions from Washington. He warned that the US tariffs could prompt a flood of redirected imports from Southeast Asia and China into Europe, threatening EU industries further. Quote, "All the instruments are on the table," end quote, Macron affirmed, urging European industries to stand united. As the transatlantic trade dispute intensifies, the EU appears ready to push back with the full weight of its economic and legal arsenal. As we discussed yesterday, the UK, which isn't in the EU, obviously, and faces a much lower tariff rate of just 10%, is in a much more favorable position to negotiate a trade deal with the United States, and may end up having a much more advantageous position than the European continent in its future trade relationship with the world's biggest economy and market. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. We normally take the weekend off, but with so much going on, there may be an extra episode over the weekend. I hope you enjoyed today's episode. I hope you have a good and restful weekend, and I will either see you this weekend or on Monday.